Imagine walking into a store during a huge sale. Everyone's rushing to grab products at low prices. The moment the price drops, buyers flood in, and as soon as the shelves are empty, prices rise again. That simple idea is what drives one of the most powerful concepts in trading: demand zones. In trading, demand zones are the areas on the chart where institutional buyers or smart money have previously entered the market in large quantities. When price returns to those areas, those same buyers often step in again, causing price to rise. These zones represent imbalances between supply and demand, where demand clearly exceeds supply, pushing price upwards with strength. So, how do we recognize a true demand zone? Let's break it down step by step. The anatomy of a demand zone. A demand zone is typically formed just before a strong bullish move, a moment where big buyers enter and cause an obvious displacement in price. The classic structure looks like this: a short period of consolidation of sideways movement, accumulation. Then, a sudden breakout with large bullish candles and little to no overlap between them. The area of consolidation before the breakout is where institutions left unfilled orders. When price later revisits that zone, those orders can get triggered again, creating a new bullish reaction. Think of it like a trampoline. Every time price falls back into that area, it bounces up because buyers are waiting there. The second, how demand differs from support. A lot of beginners confuse demand zones with support levels, but they are not exactly the same. Support is usually an horizontal line drawn at a price level where price has reacted before. A demand zone, on the other hand, is a price range, a block of space where institutional orders exist. It's more dynamic, and it often comes from a clear order block or accumulation base. Support is where retail traders look. Demand zones are where institutions act. The third one is identifying a demand zone. Here's how to spot one. Find a strong bullish impulse move, a candle or series of candles with large bodies and minimal wicks. Look at the base of that move, the last bearish candle or small consolidation before the breakout. Mark the area from the open to the close, or the high to the low, or that base as your demand zone. Once it's marked, wait for price to retrace into that area. If it shows bullish reactions again, like rejection wicks or engulfing candles, that confirms the presence of active buyers. The logic behind demand zone is the number 4. Why do these zones work? Because institutions can't place all their orders at the same time. Their trade sizes are so large that they need multiple entries to build a position. When they start buying, price moves up too fast, leaving some orders unfilled. So when price comes back down later, they use that opportunity to complete their buying. That's why these areas tend to hold. They are not random, they are the footprints of smart money. The number 5 is types of demand zones. There are 2 main types you will see on the chart. The first one is the rally-based rally, RBR. Price rallies, pauses briefly, then continues rallying. The base is the demand zone. The second one is drop-based rally, DBR. Price drops, finds strong buying pressure, forms a base, then shoots upward. RBR zones are continuation patterns. They form within ongoing uptrends. DBR zones are reversal patterns. They often appear at the end of a downtrend. 6. How to trade demand zones. Let's go through a simple strategy. Identify a strong bullish move that broke previous structure highs. Locate the last bearish candle or small consolidation before the breakout. That's your demand zone. Wait for the price to retrace into the zone. Look for confirmation, a bullish engulfing candle, long wick rejection, or liquidity gap. Enter a long trade placing your stop just below the zone. Your target can be the previous high or the nearby supply zone. The opposite concept where sellers are waiting. Confluence and confirmation. Demand zones work best when confirmed by other tools. For example, a Fibonacci retracement aligning with the zone like the 61.8% level, a fair value gap overlapping the area, or a bullish market structure break right after price taps the zone. When multiple pieces align, you're not guessing, you're confirming institutional activity. Refining the zone. Not all zones are equal. Here are 2 rules to redefine your demand areas. Focus on zones that cause a clear break of structure. Those show real institutional strength. Avoid zones that have been tested many times. They lose power as on-field orders get absorbed. Let's say you're watching Euro USD. Price drops into a key area where you spot drop-based rally formation. The last bearish candle before the rally becomes your demand zone. You mark the area and wait. Hours later, price retraces back into it. During the London session, grabs liquidity below equal lows and forms a bullish engulfing candle. You entered long with a stop below the zone and target the next structural high. The move plays out perfectly because institutions re-enter when they initially bought. When you understand demand zones, you start thinking differently. You stop buying at random highs and start waiting patiently for price to reach zones where value exists, where institutions see opportunity. You're no longer reacting, you're anticipating. It's the difference between chasing and positioning. So let's recap. A demand zone forms where big buyers cause a strong upward move. It represents institutional buying interest and on-field orders. Price revisiting that zone often triggers another bullish move. Work best when combined with confluence like structure breaks or imbalances. Strong zones cause structure breaks. Weak or overused zones eventually fail. In short, demand zones are where the real buyer power hides. They are not just areas on a chart. They are footprints of smart money showing where price found true value. So remember, every time price falls, ask yourself, is it dropping? But is it dropping into demand? Because that's where opportunity begins.